Hi everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing from VSE Corporation, and let me tell you, it's a bit like watching someone juggle chainsaws. They're acquiring companies, refinancing debt, the whole shebang. It's either a sign of incredible growth or a spectacular faceplant waiting to happen. Let's find out which act. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these filings with other people. So the big news here is that VSE Corporation has entered into a new credit agreement, basically a loan deal with Citizens Bank and some other lenders. This is a 5-year agreement, meaning it lasts for 5 years and it's secured, meaning the lenders can take VSE's assets if they don't pay up. Think of it as VSE taking out a big mortgage on their company. This credit agreement has two main parts. First, there's a term loan facility for $300 million. This is money VSE borrows and has to pay back over time, like a regular loan. Then there's a revolving credit facility for $400 million, wingline facility for short-term borrowing, like when they need cash quickly. This loan agreement comes with some strings attached. VSE has to follow certain rules called covenants about how they manage their money. These rules limit how much debt they can have, whether they can sell off parts of the company, and if they can buy back their own stock or pay dividends to shareholders. It's like the bank is keeping a close eye on VSE to make sure they don't do anything too risky. The term loan, that $300 million chunk, isn't just sitting there. VSE has to pay it back in installments, meaning regular payments over time. For the first 2 years, they'll pay $7.5 million a quarter for third year and $22.5 million a quarter for the third year, and $22,035 a quarter for the third year, and $22.55 million for the last 2 years. The remaining balance, whatever's left, is due on May 2030, the final maturity date. So they're paying it down gradually, but there's a big payment at the end. Now, let's talk about interest, because that's how the bank makes money. VSE can choose between two interest rates. One is tied to the term ESO rate, which is a benchmark interest rate, plus a margin. The other is tied to the ABR, or alternate base rate, plus a margin. The margin, that extra percentage they add, depends on how much debt VSE has compared to its earnings. It's like a credit score for companies. The more debt they have, the higher the interest rate. Here's a quick breakdown of how that interest rate margin works. If VSE's debt is more than 3.5 times their earnings, the interest rate is higher, 2.25% on top of the term SOFR, or just 0.25% on top of the ABR. If they manage to get their debt down below 1.5 times their earnings, the interest rate drops to 1.25% above term SOFR, or just to 0.25% above term SOFR, or just 0.25% above term SOFR, or just 0.25% above term SOFR, or just 0.25% on top of the ABR. If they manage to get their debt down below 1.5 times their earnings, the interest rate drops to 1.25% on top of the ABR. If they manage to get their debt down below 1.5 times their earnings, the interest rate drops to 1.25% above ABR. Basically, the less risky they look, the less they pay in interest. So what did VSE do with all this borrowed money? Well, they used the term loan to pay off their old debt from a 2018 credit agreement. They also used some of it to cover the fees and expenses of setting up this new loan. The revolving credit facility, the $400 million credit line, will be used for general business purposes like funding day-to-day operations, making acquisitions, buying other companies, and investing in new equipment. Okay, so that's the financial stuff in a nutshell. Of course, there's a lot more detail in the actual credit agreement, but that's the gist of it. VSE got a big loan, paid off their old debt, and now has some extra cash to play with. But wait, there's more. This filing also mentions that VSE acquired Turbine World Industries, LLC. This company specializes in repairing and overhauling complex engine parts, mainly for business and general aviation aircrafts. This is separate from the loan. To get more details about this Turbine World Industries acquisition, you can check out the press release VSE put out on May 1, 2025. It's included as an exhibit in this filing. Also, there's another press release about the refinancing of the term loan and revolver, which you can find in Exhibit 99.2. Finally, this report was signed by Toby B. Leibowitz, Chief Legal Officer and Corporate Secretary, on May 2, 2025. Now let's step back and look at the bigger picture. Cups of VSE is clearly in growth mode. They're taking on more debt to fund acquisitions and expand their operations. The acquisition of Turbine World Industries makes sense. It adds another service offering to their portfolio. However, taking on more debt always comes with risks. If VSE's earnings don't grow as expected, they could struggle to make their loan payments. The covenants in the credit agreement could also limit their flexibility to respond to changing market conditions. They are walking a tightrope right now. Overall, VSE's strategy seems reasonable. They're betting that they can grow their business enough to justify the increased debt load. But it's a bet, and there's always a chance it won't pay off. So I would say be cautious and do further research before thinking about investing. Alright, that's our breakdown of VSE's latest filing. What's your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate documents. Don't forget to check out the Discord community in the description where we discuss filings. Thanks for watching. See you next time.